Chris Hensley is a registered representative of Cambridge Investment Research, Inc., a broker-dealer member of FINRA SIPC, investment advisor representative of Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Houston First Financial Group are not affiliated.
The Houston Midtown chapter of the Society for Financial Awareness presents Money Matters with your host, Christopher Hensley.
Good morning, everybody. You're listening to KPFT Houston. I'm Chris Hensley. The show is Money Matters. It is 10 a.m. We got a great show lined up for you today. Most Americans fall too short in achieving long-lasting financial success in retirement. Conventional wealth-building wisdom has been leading Americans astray for well over 35 years. In fact, following traditional financial methods towards wealth has led to 96 out of every 100 Americans failing to achieve true financial success. Author, tax attorney, and CFP Rebecca Walser, in her new book, Wealth Unbroken, will do a deep dive into this topic and discuss this with us. So please stay tuned. Keep listening. She is our guest for today. But as always, if you are a longtime listener, you know we do reserve the first few moments of the show just to tell you a little bit about what's going on in Houston and in the Gulf Coast region when it comes to financial literacy. We do have, if you listened to last week's show, we had Erica Jones from the Federal Reserve joining us to talk about Houston Money Week 2018. So not 2017, but 2018. And this takes place every April during Financial Literacy Month. I am a member of the leadership team of Houston Money Week, and we have been doing this. This is actually our 10-year anniversary. So this is a very special year for us because not only is it grown each and every year that we've been participating in Houston Money Week with different nonprofits, different for-profits, different banks, local government, who are schools, federal government, all participating to help bring financial literacy to low, moderate income, really all Houstonians, because we kind of go across the gambit with different topics that we roll out in what used to be called Houston Money Week. It's still called Houston Money Week, but it used to take place in just 1 week in April, has now become really a month-long event. So we had Erica on last week to kind of tell us what's going on for this year, since it is a special Houston Money Week year, the 10-year anniversary. I would encourage people to get onto the website, houstonmoneyweek.org. You will see kind of a sample of all of the different events that we had going on last year, and there was a whole bunch of them. This year, I would encourage you to check back in on that calendar, because once we start getting all of the events for 2018 listed, it's as easy as really just putting in either the topic that you're looking for. So if you want to figure out how to have help with tax preparation, you can look at one of our local nonprofit partners that are VITA sites that are doing free tax preparation for low to moderate income. Or if you want to learn about retirement, or you want to learn about different credit topics, that sort of thing, you can go in there by category. You also have the option of going in there by zip code. So if you live in say Pasadena, or you're out by NASA, or you're out in the Woodlands and you want to find out what's the closest free financial seminar or class or workshop for me, you can punch in your zip code and it will tell you what is closest to you. With that, let's go ahead and get our guest on the line, because I want to make sure to have as much time as possible with Rebecca here. Rebecca, are you there?
I'm here.
Excellent. Well, thank you so much for joining us today.
I'm excited to be here.
Well, Thanks
for having me.
Yeah, absolutely. So we're in a very topical time because you not only are you a certified financial planner, but you're also a tax attorney, and you also have a book coming out in January, and we just passed the tax bill. So it seems like a good topical guest to have on for today. So usually I'll start the show the same way. I like to share just a little bit about you. So I'm going to share your bio with the listeners so they can get to know you a little bit better. Rebecca is a tax attorney, a certified financial planner, and she is releasing a book in January called Wealth Unbroken, Growing Wealth Uninterrupted by Market Crashes, Taxes, or Even Death. Now, that's going to be coming out in January. Now, you're also known from your weekly Smart Money Monday segments on nationally syndicated daytime television shows seen in over 70 markets. You've also been featured in U.S. News and World Reports, Bloomberg, New York Post, New York Daily News, Yahoo Finance, ABC News, NBC News, CBS News, Fox News. Let me catch a breath here. Miami Herald, Boston Globe, LA Daily News, International Business Times, Investing Daily, Street Insider, and numerous other media outlets. Once again, Rebecca, thank you for joining us.
Yes, thank you for having me. I'm excited to be here.
Now, outside of the bio, is there something interesting about yourself that maybe is not in that bio that you could share with us just so that we can get to know you a little bit better?
Well, yeah, I was born in Japan, and but my dad was in the Navy, so I was literally, surrounded by people that are English speaking. And my whole life, every time I tell anyone I'm born in Japan, they always say, "Can you say something in Japanese?" Well, my sister learned how to say Merry Christmas for a Christmas play one year. And I thought it was in Japanese, so I used to tell people that until I realized when I was about 21 that it was actually Chinese.
That's awesome.
So there you go. That's something funny that was embarrassing for a large part of my life, realizing how many times I said it to people.
Interesting. Well, let's kind of dive right in. I want to ask you about the book, and we will also get around to the new tax bill. But before I do this, as a financial advisor, you're a financial advisor as well, and I always have, when we talk about taxes, since I'm not a CPA, I always have to make the disclosure that if we talk about taxes, to always seek out a tax professional to when it comes to specific advice. But with that disclaimer, let's talk about the book. Let's dive right into Wealth Unbroken, which is coming out here in January. Why did you write that book?
I have been in finance for 20 years, and I practiced finance professionally with PricewaterhouseCoopers and IBM. And then real estate finance as well before I went to law school. And then in law school, of course, I gravitated towards tax law because that's the financial part of law, if there is any kind of financial part of law. And so I went to the University of Florida, and then I went to NYU in New York City to get my advanced law degree in tax. And I started practicing law, and after about 2 years of doing just sole practice of law, I realized it was going to be really hard for me to just practice law. So I opened my own practice 3 years ago where we do a kind of holistic plan around both tax and finance. And I realized that this is kind of what America is missing. They are missing looking at building wealth from the perspective of tax. And this is a big, huge problem. And it's forecasted to be a tremendous problem for those people that are retiring 10 years and out. And no one's talking about it. I think it's the unspoken thing that is not being talked about. We all talk about asset diversification as financial advisors, but we don't talk and we don't educate around tax diversification. And as a tax attorney and writing this book and all the research that I took, I really believe taxes are going to be the largest coming threat to wealth, more so than anything else.
So I agree with kind of your thesis there that a lot of financial advisors, as a financial advisor, there are things that we can do that are tax conscious or will put people in a better position. But often by the time they get to us, it is not. It's reactive instead of proactive. And so having a CPA or somebody, and even outside of a CPA, who knows about the thousands of different lines of tax code out there, what would you say are some of the things that should be on our clients or even advisors' radar when it comes to taxes?
Well, the conventional wisdom really, and I know you've heard this a zillion times, we've all heard it a zillion times, is we really went away from the company pension system to a defined contribution 401k wide type system in the early 80s. It really became really prominent in the early 80s. And the problem with that is the conventional wisdom that has to go along with that for that to make sense is that, don't pay the tax while you're working because you will make less in retirement, and because you'll make less, you'll pay less in tax when you retire. So you could basically save this dollar in wealth and use it when you retire, and because you'll be in a lower tax bracket, because you'll be making less, you'll pay less. That's really been the conventional wisdom that has kind of gone along with our massive acceptance of the pre-tax wealth accumulator like the 401k. But the problem was when that came out in the 80s, nobody really forecasted what 30 years down the road would look like. If you think about it, 1981, the baby boomers were like 16 to 34 years old. And in 1981, when Ronald Reagan was inaugurated or was basically took the oath of office, we only had $980 billion of debt. So we didn't have a debt problem, and we didn't have a baby boomer retirement problem. And now, 30 years later, we are staring at over $20 trillion, close to $21 trillion of debt now, tax cuts that have just been passed, which will also increase the debt, and now, of course, the largest retirement of our baby boomer population, which is our largest organic born population. Those people all going onto our social programs, Social Security and Medicare, which are severely underfunded, are going to put so much pressure on our tax system that mathematically we just feel as a certainty that taxes will go up, and they will go up substantially. And so what ends up happening if you put your wealth into a pre-tax bucket and taxes go up, you could make less and actually pay more in tax in retirement.
I hear what you're saying. So in 1981, when a lot of these changes rolled over, when you saw a lot of it going from traditional pensions, you think of parents in the post office and the Army and that kind of stuff to more of a 401k where you're just using kind of a tax pre-tax dollars and putting them aside there. That's a completely different animal than what we're looking at right now. That things have shifted. And you made a good point. You said that most baby boomers at that time were a lot young. We're not at those record numbers of baby boomers hitting the Social Security system and the Medicare system, and really just kind of having an explosion of people trying to use those services. Tell us a little bit more about what are some of the things some of the things that you suggest, or I would say tips, especially as we get towards the end of the year.
Mm-hmm. So tax tips to save tax this year. The thing that is always the best is to do some sort of charitable deduction. You'll always get the biggest bang for your buck unless you're doing some kind of crazy oil and gas scheme, which we don't recommend. A lot of people do, though, probably in Houston, right, and in Texas.
Actually, I'm completely with you. When I see that stuff, I'm like, private placement oil stuff. No, okay, keep going.
Yeah, no, totally. So not to offend anybody, any Texans there, but we don't do anything that's crazy. So I would tell the American public that the standard bang for your buck, the largest bang for your buck in the tax code as far as getting your tax bill down, is going to be your charitable deductions. And what a lot of people don't know, and that's really, really applicable right now, is if you have a portfolio, let's say you're holding some stocks and they've appreciated. Well, a lot of people think, well, let me cash in my stock, pay my capital gain, and then I'll donate this cash to a charity and use that 50% write-off of, you can write off the 52% of your income if you donate to charity. So the thing is that you can actually find charities that will accept your appreciated stock at value. So what happens is you avoid paying the capital gains, and you still get the full value of the appreciated stock as credited towards your actual charitable deduction. You just have to find a charity that will accept appreciated stock.
So and I think there's a lot of them out there that will accept it. It's probably more than most people think.
Absolutely. The standard, the largest ones, Red Cross, Cancer Society, these main ones absolutely will accept it. So it should not be hard. The ones that are smaller might be more difficult to accept, but the other ones definitely will.
So somebody who's a high income earner and maybe they're paying a lot of taxes, do they get to take that deduction for that year when they make that donation?
Yes, absolutely. It has to be made by December 31st. And then basically you're able to, if let's say we made a charitable deduction of $1,000, that $1,000 can be directly itemized on Schedule A as a charitable deduction. So it's literally dollar for dollar taking down our adjusted gross income. And we can do that all the way up to 50% of our income. So let's say our income, for sake of easy numbers, is $100,000. We can write off up to $50,000 of our income if we're giving that charitable donation to charity. So we are donating quite a bit there. I'm just using those as some high-level examples.
So that's definitely one that people, if you're into philanthropy, if you are somebody who's doing charitable donations, definitely something to look at. What other kind of you mentioned that December 31st deadline there. When we think about the end of the year, I know I always look at, I'll have clients that require minimum distributions, things that will bubble up towards the end of the year. What other things do we need to have on our radar when it comes to taxes or things to put ourselves in a better situation financially?
Yes, that's a great question. I just want to go back for one quick second, though, and just talk about the RMD, touch on the RMD, because do you find that happens a lot where people aren't aware of this requirement for some reason? And even though their custodian of their IRA or their 401k or whatever it might be is supposed to send them a notification that they have to take a required minimum distribution, they don't read it, or they think it's just, some kind of prospectus paperwork and toss it to the side.
Yes, that does happen. Usually, if it's the first time they're taking their RMD, it's fuzzy, and there's a little bit of different rules about the first year. But after that, the custodian is supposed to send them something, and maybe it gets into the circular file cabinet. I'm not sure.
Right, exactly. And the thing is that, if they don't take it, not only must they take it when they realize it, but then they also have a 50% tax penalty for the amount that they did not take. So it is extremely, it's an extreme penalty under the IRS code. It's one of the highest penalties for what people, inadvertently maybe miss. And the reason for that, obviously, the whole reason the RMD, it's funny that we're talking about this, because the whole reason the RMD came about was because people got to retirement and said, I don't want to take out this money because guess why? I have to pay the tax.
Right.
Turns out that we build wealth pre-tax, and then we go to take it out, we still don't want to pay the tax. So the bottom line I've realized over years and years and years is it does not matter when you pay it, it always hurts, and you don't want to do it. If you want to do it, if you absolutely just want to avoid paying the tax at all costs. And that's just human nature. It makes sense, So the thing that I would look at is a lot of people, and I don't know how your practice works, Chris, but a lot of people at the end of the year, CPAs included, will advise clients to, maximize maybe an IRA contribution or something like that in order to reduce taxes. I would just really encourage people I always encourage people to take the match. If they're with a 401k and their employer gives them a match, always take the match.
Mm-hmm.
But if we're at the end of the year and our CPA is calling us and saying, we can reduce your tax this year if you want to put, $5,000 into an IRA or $5,500 or $6,500 if they get the catch-up provision, I would just encourage that person to think about that for a minute and just think, okay, we have really low taxes right now. If I don't take this money out until another maybe 5, 7, 10 years, what is our tax rate going to look like in America 2027? You know what I mean?
Yes.
That's really the question that you have to be asking yourself is, okay, yeah, I can save money right now, but what is it going to cost me later? This is the new way we have to start looking at these kinds of contributions. And I would encourage people to really start to leverage the Roth as much as possible. If they are not income phased out where they can make contributions directly, or if they make the contribution to an IRA, but then they go ahead and convert it to a Roth and pay the tax, that would be another way they could still actually get money into a Roth.
Excuse me. Interestingly enough, Roth is a great way to lead into the current tax, the tax bill that passed. I'm going to go back because the RMDs that you just mentioned, that kind of finishes the thought that you started with, where, you know, the idea of people saving starting in the 80s when they switched from defined benefit plans or when they switched from pensions to defined contribution plans, and they were having to take more of the responsibility themselves, and they were, the idea was that you're not having to pay taxes now, but that your tax rate will be lower. I guess that's the end of the thought there is, are taxes going to be lower in the future? And that's where, if they are, great, but if they're not so good, because you are at some point required to take your RMDs, even if you don't need them, even if you've got a bucket of money somewhere else. And then you also mentioned, and I took a lot of notes when you were talking here, that 50% tax. And I put an underline under that because that's huge. It's a penalty if you don't do that on time. And then we talked a little bit, just mentioned Roth, and I know that there's going to be, oh boy, lots of changes with the new tax code, but the Roth, I think there's something with the backdoor Roth strategy. Maybe there. Can you speak a little bit? Just give us some commentary on what your thoughts are on this new tax bill.
Great, Chris. So what you're talking about is they're not eliminating, although Orrin Hatch had introduced a Senate amendment, the Hatch Amendment, where he did want to eliminate the ability to convert IRA money to Roth. So that was a proposal. It did not go through, though. What you're talking about is they have eliminated the ability to recharacterize a contribution or an actual conversion. So if you right now decide to convert IRA to Roth, and then the market goes down, and you would have been better off to do the conversion later because you would have been paying money on less actual principal,
right? You
know, the tax. Then you can undo your Roth. You can recharacterize that conversion, undo it, so that basically you can reduce your taxable impact. That has now been eliminated with the implementation of this bill. That's what that is. That is the change that has been implemented when it comes to the Roth. But the Roth conversion itself has not been eliminated through this actual bill, which is a really wonderful thing, because I think one thing that was really telling about Orrin Hatch's amendment when he said, look, we want to stop you from being able to convert IRA money to Roth money, that is like a huge red flag waving in the air that I just want to tell people, you realize what this means. You realize what this signals. Because the government is not telling you that you can't pay the tax. You can, in fact, pay your tax on your IRA money at any time. It's your decision. It's your choice. That's the one thing you have in retirement, is the freedom to choose when to pay your tax with your IRA, as long as you take out the minimum RMD required. But what they are saying is, you still can't not allow you to pay your tax, but we can prevent you from putting it into a Roth, which means it and all of its growth forever will at all times be tax-free. And what we're starting to see is government say, whoa, we can't really afford to have people's wealth growing in a tax-free account for the rest of their life because we need income, we need revenue. And that is really telling.
I totally agree with you. It's scary. I've gone out, and when I work mostly with people who are using state pension to retire, and they're 55 and up. And one of the things I talk about is how good having that bucket of tax-free money is on the back end when they start looking at whether your Social Security is taxed or whether you have to pay higher for Medicare. That having an additional bucket of tax-free income is a good thing, so much that I was scared that they will actually take it away from us. And I know. And that's kind of the what we're alluding to here. And then you mentioned earlier the recharacterization. So if you use a strategy like making contributions into or recharacterizing traditional IRAs into Roth income tax, and you're converting it, well, the idea is that it's a better taxable strategy for you. But if that's not the case, you at one point had the ability to go back and fix it, to go back and recharacterize it, and that piece of it they're taking away. But it looks like the rest of it so far, knock on wood, we're still good on the rest of it there. What other things we were actually bumping towards the end of the show? We've got about 7 minutes left. What other things do you want to tell us about the tax code? Or the new tax bill?
Yeah, the new tax bill. A couple of main points to focus on here, Christopher, that will affect everybody, obviously, is, so, all of the brackets have been adjusted, which is great. Even the top bracket went from 39.6 to 37, so that's a positive across the board. What is really the big issue, it's not an issue for Texas and Florida, really, in my opinion, but it is a big issue, and it's been the biggest issue, is where in the area we call SALT. result is state and local tax. And state and local tax, if you think about the Californians, the New Yorkers, the Illinoisers, I don't know how you say those, but basically, if you think about it, what they have is they have really high property taxes and they have really high state income tax. So if I am dealing with a client from California, I will expect to look at their Schedule A itemized deductions, and I will see, a $40,000 state property tax bill. I'm just throwing this number out there. Mm-hmm. And then let's say they've paid another $20,000 in state income tax. Those two things together, $60,000, will come off right on their Schedule A as a write-off completely for federal income tax purposes. That has now been eliminated or reduced down to a threshold maximum of $10,000. So this is why you've seen all of these high tax property and high income tax states be really upset that this bill has this $10,000 limitation. And, it's been really interesting that the vote went directly down party lines. No Democrats voted for it. No Republicans voted against it. It was a complete partisan vote. And what you're seeing is that these states are mostly represented by Democrats, these high tax states. And the Republican states, they are like the Texas and the Florida and the Tennessee, the states that have no state income tax and just property taxes, don't seem to have a super big problem with it. We don't have tax bills on property taxes much over $10,000 unless we're talking about a house that's $1 million house and up. I don't know how your taxes are looking, Christopher, but that's pretty much what it is from all of the information I see with Texas, Florida, and these income tax-free states. The property taxes aren't that astronomical that $10,000 would eliminate a lot of homeowners from getting that full deduction.
So this is a very important point that when I do retirement planning with people who are sunsetting, they're turning off their paycheck and they're deciding I'm going to retire, I'm going to live off of my assets for the rest of my life. If they're making that decision where to live, they might, and I believe you're there in Florida. I'm here in Texas. Mm-hmm. We don't have this issue, but I do have clients that are out of state that are in California, where that when you're talking about that $10,000 limit, I can see where the state, if that is a revenue producer for them, that would be a different. As far as from my perspective, when you're working with retirees, that should be something on their radar when they're deciding where they're going to end up spending the rest of their lives. So that's extremely important, and a lot of times that state income tax, that property tax piece gets completely left off. So that's important. I want to get back. So I know we just basically touched the beginning of the tax bill, but I wanted to get back to the book before I'm done with our time here. What other things did you put in Wealth Unbroken that are kind of well, let me put it this way. I was looking through the when I was researching it here, and it talks about going out past your life, and that many people will leave that off when they're doing their planning. Can you just touch on that for a little bit with us here before the end of the show?
Absolutely, Christopher. It's obviously, of course, we want to help retirees not outlive their money. We want to, we want to mediate longevity risk, and we want to make sure that their money lasts as long as they do, and that's very important. But there's a step beyond that, which is really deciding what kind of legacy can I leave for my family and my heirs. And it's a lot of people think, well, I don't even have enough money, to even think about that. That's really not the case. There are tools out there that we do leverage that are really tax-friendly, tax-advantaged, and do leave a legacy. So we do want to think about and start to adjust our mindset to say, are there little things I could do, I could add, I could touch on that would make a huge financial difference for my family, for me having been a part of it? And that's really the part of keeping your wealth growing even beyond death. It's not just about you, but it's also about, your heirs and who's to come after you.
Excellent point, and we are right here towards the end of the show. So I want our guest today, Rebecca Walser. If you'd like to find out more about her, she is a certified financial planner. She's also a tax accountant. Her website is www.walser, that's WALSER wealth.com. We are also today, we talked about her new book that is going to be released in January called Wealth Unbroken. That is available on Amazon. And Rebecca, as we finish the show here, is there anything I forgot to ask you that you would like our listeners to know? Just
want to know, there's a lot of financial books out there, Christopher. Obviously, you know that. My book is unique. I am a lawyer, and I really build a case as a lawyer to sort of establish the proof and the data behind my opinion of what is to come and where we have to change how we grow our wealth because of what is to come.
Thanks for listening to today's episode of Money Matters Podcast. If you enjoyed the show, visit us on the web at www.moneymatterspodcast.com. Drop us a line on SpeakPipe on the right-hand corner. It will receive any voicemails, questions, thoughts, concerns that you have about the show. In addition to this, we recently launched a Patreon campaign. Click on the Donate Now tab to hit the tip jar and find out what Patreon's campaign is all about.